Things are spiraling out of control. Trump hates BRICS, especially from countries trading outside the US. And to push his agenda, he's back to playing hardball with his signature art of the deal tactics. This might fly with G7 allies who have no other options. Their trade and defense ties are locked with Washington, so they comply. That's why Japan and Europe are basically kowtowing to Trump's demands. Now, South Korea is the latest target in this squeeze play, and the cost of their so-called freedom is outrageously high. Trump demands South Korea cough up $350 billion for investments owned and controlled by the US. Whether that's a direct investment or just a disguised gift, it's a massive hit. On top of that, South Korea must buy $100 billion worth of US LNG, expensive energy shipped halfway across the globe, even though cheap Russian LNG is right next door. Logistics? Forget it. For all this, South Korea gets a 15% tariff on imports from the US, while refusing to charge any tariffs back. How wildly unbalanced can this get? This is what happens when dependence on US markets becomes a weapon. It's a brutal deal for South Korea, but predictable given their tense relations with North Korea and heavy reliance on US troops. But don't get it twisted, this deal will hurt the US economy too. Like Canada, Japan, and Europe, Korea exports critical goods to the US, so prices will spike and hit American consumers hard again. Korean exports to the US break down to 31% automotives, 18% electronics and semiconductors, 21% machinery, and the rest mainly raw materials needed by US industries. This means production costs and living expenses in the US will skyrocket. Trump's tariffs are just a giant bailout, forcing American consumers, private companies, and the federal government to pay the price. How will this convince foreign companies to relocate their factories to the US? It won't. US consumers bear the burden and forget about exporting US-made goods abroad. Margins will vanish or go negative. Just when you think the chaos will calm, Trump escalates further. Now he's targeting a founding member of BRICS, threatening a brutal 25% tariff on India, which might already be in effect. This tariff could obliterate profit margins and devastate exporters. He's also tying India's Russian oil purchases into this mess. The 25% tariff is just the starting point. Secondary tariffs on Russia's trading partners could follow, pushing the situation into chaos. With the G7 folded, Trump's looking east to squeeze more deals, and India's first on the list. The plan is clear. Force India to buy Boeing planes, cut ties with China, and purchase costly US energy. Trump is eager to replace Russian oil with pricey US crude. The blow to India will be immediate, and the US economy will absorb more stress. India's largest exports to the US aren't critical goods, which complicates things for them. Roughly 28% of gemstone exports, 45% of diamonds, and 35% of other luxury stones head to the US, all discretionary items consumers can do without. A 25% tariff could crater demand and cripple India's diamond industry. But looking at India's bigger exports, pharmaceuticals, smartphones, electronics, apparel, around $26 billion worth of consumer products will get hammered. Trump is playing US consumers as bargaining chips, hoping India caves. Really, his goal is to boost Boeing sales. The real kicker is the punishment for buying Russian oil. India is the test case, importing nearly 2 million barrels a day from Russia. Over half of Russia's shipments head to Indian refiners, often at 10–30% discounts. You can't blame India. Everyone needs to keep energy costs down in this tariff war. Like China exports goods deflation, Russia exports energy deflation. That's why Trump starts with India. He wants to choke Russia's crude revenues. If India backs down, so might the rest of BRICS and other buyers. Or so he hopes. Will India fold? It's uncertain. Modi can't just sever ties with the US, still hoping for economic integration. But if India stops buying Russian oil, only China benefits. India surrendering oil volume to China will make Beijing stronger, and Trump probably didn't account for that. China already imports over 2 million barrels a day of Russian oil. If India loses its share, China will absorb it, creating a glut. Chinese refiners will flood the world with cheaper oil products, making plastics cheaper and cutting production costs overall. This will squeeze global competitors, especially the US. Squeezing Russian crude without serious fallout? Impossible. Biden tried from 2022 to 2024, the EU is still trying, they all failed. Trump won't succeed either, it's a colossal waste of effort. Even within China, Western businesses feel the heat. Competition is fierce, even inside China's own ecosystem, despite supply chain advantages. For the first time ever, Apple is closing one of its retail stores in mainland China. This is huge because Apple is synonymous with expansion, and China accounts for 10% of its global retail footprint. Something's seriously wrong with Western brands being crushed in China. Apple does import some parts for phones, but the devices sold in China are mostly made locally. The root cause? Chinese consumer perception of Western brands has soured amid ongoing U.S. attacks on China's tech industry, stoking a wave of nationalism. Local Chinese people have come to a clear realization. They must rally behind their own local brands to ensure their survival, especially since many Chinese companies are either banned outright or face crushing tariffs in the U.S. market. This shift in consumer mindset has sparked something truly remarkable in Q2. Huawei, once struggling under intense pressure, has clawed its way back to the top of the Chinese smartphone market, selling over 12 million devices and capturing nearly 20% of the market share. A stunning 15% growth in just a few months. This isn't a one-off success. Other Chinese giants like Vivo and Oppo are also expanding rapidly, pushing forward with strong sales and innovation. Meanwhile, Apple, which once dominated China's smartphone landscape by cornering almost a quarter of the market back in 2023, now languishes at just 15%. The tides have turned completely. Chinese technology has not only caught up, it's sprinted ahead. Huawei's ability to design and manufacture its own cutting-edge chips makes their phones world-class, matching or exceeding global standards. Meanwhile, brands like Vivo and Xiaomi sell smartphones that deliver solid performance at a fraction of the iPhone's price, often just 1/5, making Apple's premium pricing seem out of touch with the evolving Chinese consumer base. Apple is caught in a squeeze. Their products cost too much, offer less perceived value, and increasingly fall out of reach of China's expanding middle class. Add to this the widespread anger and frustration over U.S. tariffs, and you get a consumer base that is actively turning away from Western brands. Why pay more for less and at the same time help fund an adversary's economy? It's a simple calculation that almost anyone with common sense can make. If this trend persists, American companies will lose out on massive revenues from one of the largest and fastest-growing economies in the world. Despite ongoing trade tensions and tariffs, China's economy continues to expand robustly. The IMF recently revised their growth forecast upward from a previous estimate of 4% to a more optimistic 4.8%. This jump is significant and underscores a larger truth. The global economy cannot and will not turn its back on Chinese goods. The Chinese government is pumping massive amounts of capital into the system to fuel growth, innovation, and consumer spending. If the U.S. trade war drags on, the biggest losers won't be Chinese companies, but U.S. firms themselves. Turning to gold, the precious metal has been stuck in a holding pattern, fluctuating between $3,200 and $3,400 after reaching a peak of around $3,500 in April. The market is waiting for a major catalyst to push prices higher, but several facts remain clear. BRICS nations continue to accumulate gold reserves aggressively. G7 countries are demanding the return of their bullion, and central banks worldwide are boosting their holdings. A prominent asset manager has recently projected that gold could surge to $4,000 by the end of 2026, offering three main reasons that have been repeatedly discussed. Ongoing pressure from Trump to push the Federal Reserve toward dovish policies, meaning interest rates will likely drop, weakening the dollar. Continued expansion of gold reserves by central banks, and a growing wave of interest from global funds. Many funds are doubling their traditional gold allocations from around 5% to 10% or more, signaling increased institutional demand. To put this into perspective, the gold market, including physical bullion and ETFs, totals roughly $4 to $5 trillion. In contrast, the U.S. Treasury market dwarfs it at around $28 trillion. This means that relatively modest inflows of capital can have outsized impacts on gold prices. The ongoing trade war only intensifies this effect, as diminishing U.S. trade reduces the need for holding dollars and recycling money back into U.S. bonds. Since tariffs were introduced in April, gold prices have climbed steadily from about $3,000 to near $3,400, reflecting growing investor awareness of rising inflation pressures, not just in the U.S. but globally. Countries around the world, Asia, the Middle East, Europe, are increasing deficit spending to counterbalance the economic impact of tariffs. China alone is boosting government spending by an astonishing 40 to 50% this year, injecting enormous sums into its economy. It's worth remembering that government spending often comes with inefficiencies and waste, but it also funnels money into pockets of wealth, creating a segment of the population with greater buying power for assets like gold. While this alone is a powerful tailwind for gold prices, the biggest holders of U.S. bonds, like Japan and China, still hold relatively low percentages of gold in their reserves, around just 6%. Japan holds over $1 trillion in U.S. Treasury bonds, and China owns about $700 billion. There's huge room for these countries to increase their gold holdings dramatically over the next 12 to 24 months. With Trump continuing to ratchet up pressure on both the G7 and BRICS nations, no country is immune from the fallout. I sound like a broken record, but it's important to stress this. I'm very bullish on asset prices over the long term. Not because the global economy is healthy, it's far from it, but because Trump's trade policies and resulting market dynamics have effectively launched a form of silent quantitative easing. The entire system is broken, and precious assets like gold have become essential safe havens. I plan to keep buying gold aggressively. What do you think? Will BRICS nations buckle under Trump's pressure? How high do you believe gold can go by 2026 and 2027? Share your thoughts in the comments below. Stay safe, smash that like button, and subscribe as we navigate through these unpredictable and turbulent times together.